Ed mentioned, my name is John Becker. I'm a mortgage loan originator. We office out of 2 locations, one in Northtown, one in the south. Sorry for our contact. I need the clicker here. This is our contact information. What I'm going to be talking about today is home equity. Home equity is basically the currency of your home. There's 2 ways that you can receive that. You can receive it through principal payment in your mortgage payment. You can also receive it through what's called appreciation in the value of your home. Now, Eric Edelman here is a New York Times bestseller, and he states, Americans devote the largest portion of their income to housing, but consequently, how they handle the purchase of their home will have far-reaching implications on virtually every facet of their financial life, including our ability to save and plan for retirement. Home is typically never thought of that aspect of one's portfolio. They realize certain components of it, but they never take it into full picture and consideration. So what we're going to talk about are what are the elements of a prudent investment? What makes one good? Well, what you're going to realize here is that your home is going to fail the 3 principles to that test. The first one is based off of safety. If I ask everybody in this room, do you think your home is a safe investment? Most people will say yes, I believe it is. And I get a couple of heads nod. Well, what people are thinking about is the asset, not the vehicle. What does that mean? That means that here in Western New York, as Carol will attest to, that the market is either going to be pretty stable, it's going to appreciate, or somewhat depreciate. We don't have the highs and lows like out in California, Vegas, and other areas like that. So that's where everybody's thinking on the asset base, but on the vehicle base, what other asset can you guys think of that you have to be qualified to touch money? There is none. If you want to access your 401ks, whether ahead of time, you can access the money, but you're going to pay a penalty for it. When it comes to your home, it's not a safe vehicle because the bank and the lenders have the right to deny you to access your money. The only way you can ever get it without worried about the accessing is seeing someone like Carol. Selling your home, which of course is the last thing that anybody wants to do. So that's why your home is not a safe investment. The next principle is liquidity. How soon can I access the money? Well, anytime that you need equity, there's only ever going to be 2 reasons. One is going to be for an emergency, and the other is going to be for an opportunity. Well, hopefully that opportunity is around in that time, because it takes about 45 days to obtain the money out of there. But let's go back to the first point, emergency. This is an emergency. Go back to point 1. Are you going to be able to access the money when you need it? And the third one, the one I'm going to really go into a little later so everybody can understand the perspective, is there is no rate of return on the equity in your home. No rate of return on the equity of the home. Your home can appreciate. Whether you own 100% of it or none of it, it will appreciate year after year. That's the only way that you can earn money off the return, not with the money that you have within it. So basically saying, if you own a $200,000 property, that means that you have $200,000 of your money not doing anything for you. I don't think a lot of us, have that ability to have $200,000 just sitting around. Because you got to remember, this is the one thing I want to have really resonate with you. Homes are built to house people. They're not built to house investments. That's why investments are created. So let's go into the biography, or the biology, of a mortgage payment. So let's say that you have a mortgage payment that's $1,000 a month. That's just the mortgage. I'm not including the taxes, the homeowners, the MIP, anything of that nature. What are the 2 functions of that payment? What happens when you make that payment? You got it correct. Principal and interest. Now here's the next question. On your very first worst payment in a mortgage on a 30-year, what do you think that percentage breakdown of interest versus principal is?
Most of it's interest.
Give me some numbers.
92.
That is the number 1 answer what Bob had just mentioned. Yes, because historically everybody's used to the higher interest rate, so you received, you have a lot more in interest than you did in principal. In today's time, if your interest rates are around 4 3/8, 4.375, you're actually going to recapture 28% of that payment on your very first and worst payment. That means out of that $1,000, that's $280 that you, in a sense, are placing off to the side. That's monies and funds that you can access later on. But what does everybody focus on, and why people don't like 30s and why they want to move towards 15s? Interest. 72% of that payment is going to interest. That's money that people conceptually think of is gone. Now, but this last couple of weeks is the only reason why you should have a mortgage and why that interest isn't as bad as one thinks. It's because you receive a tax refund. Mortgage interest is tax deductible based off of your tax bracket. So if your mortgage is around $1,000 a month, that's around a $200,000 property, that means that you are going to be roughly taking federal and state in consideration. Mark, don't call me out. You're going to be in a 30% tax bracket. Yes, you can go up or down just a few degrees from that. So that means that out of that payment, you're going to start to receive $216 of those monies back as a credit towards your taxes. But that means that you're going to then have a net cost. That is truly your cost. That's what everybody associates interest with, is cost. Because why? We pay credit cards. We pay other vehicles that have a cost. And because when we pay those other type of products, what happens? You're paying them 100%. When you pay your mortgage, you're recapturing some of that for yourself. So as that comes down to stating that on your very first and worst payment, I'm sorry if I'm blocking it for some of you, you're going to recapture almost 50% of your payment. What type of vehicle is out there for that? There's not many. So let's take that translation now over to an interest rate. If your rate is 4.375, and by the model that we had before, your net cost was 50.4 in your very first and worst payment, that means that your net cost translated to an interest rate is 2.205. I know we've got a few bankers in the room, investment advisors, everybody else. Guys, where can you borrow money that cheaply? You can't. There's only one other industry that you can do that in. That's the auto industry. They're actually worse than we are. You can borrow a car and get it at 0%. So by that same token, it's going to be a 2.205. When you make your next month's payment, what do you think is going to happen to that overall net interest rate cost? Correct. And why is that? It's called amortization. You're going to pay every single month on a guaranteed contract over a fixed period of time more towards principal and less towards interest. So what does that mean? Over time, you keep on paying yourself greater and greater every month. And to show that as an illustration, payments 1 through 4, they do nothing but decrease over time. So what's the number one way in which banks make money today?
Fees.
Fees, that's because of the government. But historically, the reasons that they made their money, the majority of their money is an awful word called arbitrage. What arbitrage means is like what's occurring here. The banks are taking and borrowing money at a cost. They're taking the money at this cost to you. They're lending it out to the general public at this profit. That difference is the money that they're making on the money that they're borrowing. Arbitrage is a very strong factor for them. That's in mortgages, it's in their CDs, everything else that they do. So, as a result, they keep making money on borrowing money. We should take that same principle in our actions and what we do. Thank you, John. So with that being stated, if your monthly interest rate as before is 4.375, your net cost is 50.4, or the interest rate of 2.205, and you put it into a conservative 3% interest rate or return on account, you're going to have an ROI, or return on investment, of 26.5. Where do you receive that in most markets today? You don't. Most markets don't have that type of return. So, as a result, as you can see, at the next month's payment, what happens? It only betters. Next month, it only betters. Why? Because of that, the amortization. You're going to be paying more towards principal and less towards interest over time. So, with that being stated, the reason why the monthly rate of return is so low is because the economy sucks. The economy's finally starting to rebound. And as a result, we're seeing that indication. Why? Interest rates are rising. These two markets transition simultaneously. So as the market goes down, interest rates go down. As the market goes up, interest rates go up. So over time, where do we know that the market is going to start to trend? There we go. It's going to keep on increasing and going up. So by the token of this policy, the things are going through, your mortgage is going to start decreasing. But your rate of return, with a 3% guaranteed over a period of time, that differential is going to be a greater return. But your return on your money is not going to stay at 3, because if the market goes up, what's going to happen? Your rate of return is going to increase. Thus, your ROI. That's where by leveraging equity in your home and putting it in the correct places where it's safe, liquidable, and pays a rate of return is one of the best avenues that you can do. Everybody's goal is to pay off their mortgage because the old mantra was established in the Great Depression. That is one of the worst financial decisions you can ever do. Pay off every other liability you have. Free up your cash flow. Cash flow is what gives you freedom. And with that cash flow, you can start to begin to invest to who? Not everyone else, yourself. That's the principle of home equity management. I'm sorry I only had 10 minutes and I had to try and cram it all in. Does anybody have any questions? Nope, I just got the wrap up, so. There's no commercial. Thank you, everybody, for your time.
One quick question.
Oh, okay, one question.
Based on your math, if you have a higher interest rate, is there any advantage to not refinancing for a lower one? Is there a better tax advantage or?
The only thing that, as your interest rate increases, what will happen is that your net cost, or sorry, your principal will start to decrease. But also then based off of the rate of return on your money, you're going to be at the same level, it's going to grow. But what most people do and what we mostly structure is the first step is to do some consolidation. So by simply, I took a gentleman who received a car, he bought a car, his car payment was $500 a month, he had it 0%. I said, let's include that into your mortgage. With what I was showing him on his initial savings, and then by bringing the car in, there was a $76 differential. He said, John, you're crazy. Why would I take something that I have 0% on and bring it to something that has an interest rate? I go, because it's based off of cash flow. By taking now, not the $500 that was his payment, but the $426, applying that towards his mortgage, he saved over $42,000 on his mortgage. Because you applied it onto the larger picture, the holistic picture, not just the one small thing. Everybody's very myopic in what the interest rates are. You got to look at the whole picture and take a plan obsolescence, a external kind of view to it.
Good question, John. Is there any specific indicator that you would use to say the economy is good or bad? Is it just specifically the Dow Jones average or something like that?
My first indication, of course, get the professionals in the room too. Look at your 401k statements, your investments, see how those are looking for you. That's really not my area of expertise, and for me to be able to state what that is. I'd certainly go see Chris and Linda for those two facts. Sorry to defer.
That's all good.
Thank you, everyone.